This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, you're listening to the AJ Bell Money and Markets podcast, and it's our special monthly episode dedicated to investment trusts. And today we have a smorgasbord of insights, interviews, and information to keep you abreast of what's going on in the world of investment trusts. Joining me today is the editor of Shares Magazine, Tom Sieber. Hi, Tom.
Hi, Leif. Yes, indeed. Lots to cover in this episode. We'll be speaking to Dale Nicholls, manager of the Fidelity China Special Situations Trust, to get some insight on whether stimulus measures are having a positive effect on the Chinese stock market. We'll also be getting into the nuts and bolts of venture capital trusts, better known as VCTs, and discussing the generous tax relief available to those who are brave enough to invest through them.
Yeah, absolutely. We will be doing that. And with interest rates expected to fall over the next year, Dan Coatsworth will be talking to the manager of a high-yield bond fund to find out what falling rates mean for fixed income investors. We'll also be discussing the performance of Scottish Mortgage Investment Trust, one of the biggest trusts, the biggest trust, in fact, in the UK stock market, which finds itself in the uncharacteristic position of having underperformed over the last 5 years.
But first up, let's talk ethical investing. And Leif, there's been a bit of a dip in interest in ESG investing. Is that right?
Yeah, it certainly seems so. And this is based on research from the Association of Investment Companies, the AIC. And their survey basically shows that the number of investors considering ESG when they're putting money into the market is now 48% of investors. So around half, just under half, in fact, which is probably quite significant. But I think it's the trajectory which is probably more important. That's down from 53% last year and 66% in 2021. So there's clearly quite a sustained and significant change there. And I think part of the reason for that is if you look back to 2021, I think was what was happening back then. We were in the middle of the pandemic, of course, and ESG was a real buzzword. If you think about what was in the news headlines, Extinction Rebellion had in the previous few years, it really highlighted the issue of climate change. The UK government seemed to be getting on board as well. Back in 2019, Greta Thunberg had just been made Time Person of the Year. And very significantly, Joe Biden had been elected president of the United States, of course, on a green infrastructure spending ticket. Perhaps this is me being cynical, but there was also a lot of fund marketing around that time. So lots of fund groups jumping on the bandwagon obviously saw that there was a very big opportunity to sell funds. And that was then. If you think about what's happened since then, we've had the cost of living crisis. And of course, a big part of that has been paying for gas and electricity. And that's probably shifted the focus away from what the source of that energy is, more towards the cost of that energy and its supply. That's one part of the puzzle, probably. Another part is probably that returns have not been so good from ESG sectors of late. And interestingly, in the AIC survey, only 17% of the people surveyed thought that ESG investing is actually likely to improve performance in any way. And I think probably the big reason for me, is that investors have also become more skeptical about ESG claims. And that also comes through in the data from the AIC. 6 in 10 people said that they are not convinced by ESG claims. And I suggest that is a major problem and a reason why people are not looking at ESG investing in the way that there were. And just anecdotally, I've seen recently one investment trust report, annual report. It spent a long time waxing lyrical about its ESG credentials, but then if you actually scroll down to the portfolio listings, you can see actually it's invested in tobacco companies, which would probably come as a bit of a surprise.
Yeah.
And I think at a theoretical level, it is possible to square that circle. To say that, we are investing in an ESG manner, but still in tobacco companies. For instance, you could say, well, we invest across all sectors. We want a diversified portfolio, but we only invest in the best in each sector. So, the tobacco companies that are actually making a lot of effort to move across to kind of smoke-free products. But even so, I don't think that that's what investors would expect from an investment approach that's ESG in nature. So I do think there has been this disconnect between what investors expect from ESG funds and what some of those trusts and indeed the underlying companies are delivering. And that is probably leading to, this shift in terms of the popularity of that sector.
Yeah, I think that's a really good point. I mean, I suppose if there's any silver lining from this, it might be that the sort of greenwashing, in inverted commas, that you saw in 2021 might start to kind of go away, because if it's not such a fashionable sector, there's less incentive for parties to sort of dress up themselves as being ESG or whatever, because it's a hot area.
Yeah, I think that's definitely true. It's certainly kind of something that I have observed in terms of the kind of fund sphere. The number of webinars I now get invited to on ESG is significantly less than it was 2 years ago from the fund groups. But I mean, it's still a pretty big number. And so I do think there will be, ultimately there will be this sort of residual, ESG tint that is left within the fund management industry, because a lot of them have, adjusted at least their reporting, but actually their underlying processes as well, to actually take on board ESG factors to a greater extent, even though, as I say, investors might not think that the underlying portfolios necessarily look that ESG friendly.
Now it's time for us to move further afield as we look to the Far East. In the months after China lifted its COVID controls, many investors expected an almost instant bounce back in economic activity. But huge issues with the property sector and subdued consumer confidence created an economic crunch that's had a massive global impact. More recently, new stimulus measures announced by the Chinese state have given markets a fresh boost, and investors are beginning to wonder if it's time to dip back into China. To get some insight from the front line, AJ Bell's head of financial analysis, Danni Hewson, caught up with Dale Nicholls, fund manager of the Fidelity China Special Situations Investment Trust.
Dale, thank you so much for talking to us. I think it's fair to say that over the past year, we've had quite a lot of moments when investors have suddenly got really excited that finally we're going to have this great China economic turnaround. And it's sort of sometimes almost seemed that we've got there. Is there anything different about this last rally?
Yes, no, exactly right. We've clearly been dealing with general disappointment on the economics front. There's no question about that, and that's sort of generally led to earnings downgrades. And there's a few factors behind that, but clearly weakness in areas like the property market have been clear drags for the broader economy. But I think also potentially impacting the consumer confidence, and that's sort of coming through in weaker consumer confidence overall in terms of those numbers. But yeah, I mean, I think the response from the government this time seems quite different. Not so much in the numbers. I mean, obviously the numbers that we've seen come out from the PBOC, I think are really significant, but I think just generally in terms of commitment, I think to drive real change this time seems different. We'll still continue to watch closely to see how policies play out. But it really does seem to be a pretty significant change there. And then I'll just say more, in terms of the very recent economic data, very early days, of course, but we're seeing some positive signs across a range of sectors, particularly the numbers that came out over the National Day holiday are hopefully an indication of things moving in a better direction.
Really interesting when we start to see those GDP figures, because if we were having the kind of growth that China's having here in the UK, I think there would be fireworks and champagne corks going off, and yet there is still disappointment.
Yeah, it's very true, and that's something that I often say as well. It's like, okay, things have clearly been undershooting versus what we're used to, but step back and look at the overall numbers. We're still talking about a 5% number for this year. We may still undershoot, but the absolute numbers generally are relatively solid. And that's what I see at the company level as well. Obviously, we're focused on what we're seeing with individual companies, and when we sort of aggregate, the earnings trends and overall earnings growth for our companies, we remain pretty encouraged.
So you say that you feel like the commitment from the government this time feels a bit different, because I know that I'd heard a number of commentators saying, look, they needed to bring a bazooka and they'd only bought a squirt gun so far. Do you think that the stimulus announced has gone far enough?
Probably not in terms of getting actual details. Like I said, on the monetary side, I think, the action, is pretty significant. What we're all watching is what comes through on the fiscal side. And particularly the actions, that will come through in dealing again with the property sector. There's clear excess inventories, and we need to see. What I'm particularly hoping is the sort of the size of the programs that we see committed to that. It's early days. I won't get too much into the weeds around the actual programs, but I think there's an element of watching how the initial moves play out in terms of programs to address that. But again, what I think is most important is the change that we see in terms of level of commitment, to doing more to address the issues from the very top. So that's what's most encouraging for us. We have some key events to watch out over the rest of the year, so we're watching closely to see sort of actual programs. But like I said, in terms of the level of commitment, we're encouraged by what we see.
When we're talking about key events, there isn't one much bigger for geopolitical health than the US election, which is now just weeks away. Things are still incredibly volatile. So what do investors need to price in?
Yeah, we'll see how things play out. What again is positive from a market's perspective is that this is really well flagged in terms of that mindset of investors. Having Trump coming out and already talking about 60% tariffs kind of is clearly on the minds of investors, and we see that impacted in potentially related stocks. But again, from a market's perspective, what's good is that that's been well flagged. And I'll just say it's also pretty well understood for the companies themselves. Obviously, we have those discussions with companies about, the potential impact, the sort of actions they can take to mitigate. I think it's important to remember that many companies are already dealing with the levels of tariffs from the first Trump administration. So many companies are sort of operating under that 25% type of level. They're taking actions. Many have moved, significant production offshore, incremental production, for them offshore. In many cases, the competition that they're dealing with in these sectors is all Chinese to start with. So often the discussion shifts more about to more about sort of price elasticity. If prices go up for the sector, how does that impact volumes? More than, how does it sort of impact, the competitive landscape?
Has the situation in China changed? Because I'm thinking it's only 5 years ago when we were viewing China really as the world's manufacturing hub. And we were recognizing that the China consumer was becoming an ever greater consumer of Western luxury products. But both things seem to have changed a bit. What have you noticed?
In terms of being a manufacturing hub, I actually don't think things have changed that much in my mind. Of course, I think at the margin, companies, when they think about incremental capacity decisions, given everything that's happening geopolitically, are thinking about China plus one. So thinking about other locations to add capacity. But this talk of a hollowing out in manufacturing, I think, is many times overstated. If you think about an area like electric vehicles, China is the clear global leader, producing probably 50% of global production and even greater market share of the supply chain. Sort of thinking about things more upstream. They're the biggest global exporter of autos now, a position that they've sort of achieved from number 5 or 6 in the space of 3 or so years. So you've had the whole creation of whole new industry as well. And, you have many companies that are just leveraging huge domestic volume and really significantly investing in R&D as well. Again, I think the sort of that talk of China losing its position as a global manufacturing leader in many sectors is oftentimes overstated. You mentioned luxury goods as well. We've talked at sort of the outset about the weakness on the consumption side. Within that, we see a clear downtrading trend, which I guess is not surprising. Sort of in a period of weaker consumer confidence, the maybe wages aren't growing as strongly as they were, so that downtrading trend is very clear. Again, sort of stepping back, in many cases, it feels like the way the stocks themselves are priced is that we can't go back to those old trends of premiumization ever again, which I think again is overstated. I think again, if we're thinking out 5 to 10 years, within overall growth within China, the consumer, areas will grow faster or will expand as a proportion of the overall economy. And there'll be areas of strength. And I think, there will be sectors where premiumization does return. And even in, this week period, we have seen it, pockets of strength, whether it be in areas like education. I think services overall have definitely done better. Areas like travel, that sort of thing. So, there's pockets of strength. And again, when I'm thinking out 5 to 10 years, there's real opportunity in these sectors as well.
It does seem that the Chinese consumer, though, is sort of waking up to what is being produced in China and deciding to go for Chinese label goods as opposed to, saying that Western luxury goods were the be all and end all.
That's very true. I think you can say that broadly. I mean, I would still exclude luxury itself. I think, any company globally, I think, Europe has a very strong hold on sort of high-end luxury. Although the exception might be an area like Guizhou Maotai, which is obviously, in Baiju, very high-end Baiju, which you'd probably put in the luxury category. That's, clearly an area that's owned by the Chinese players. But outside of that, we see, you're right in seeing in Chinese brands really assert themselves across a range of categories. Obviously, they're very close to the consumer. They can move very fast. So, there's a range of categories within consumer where, again, we see really strong performance from the Chinese brands, whether it be in areas like cosmetics, which is one that really stands out, where, the domestic brands are clear winners now. And there's sort of different range of products within that. But I think overall, it's fair to say that, the Chinese brands have clearly outpaced the foreign brands, but also even areas like sportswear. You see, really strong domestic brands that are executing well in the local market.
And I just wanted to end by asking you, because the investors are still nervous about investing in China. So how do you go about mitigating that for investors?
Yeah, I mean, this is why the market is trading, at such a discount to other markets, because of these concerns. Again, I find oftentimes the geopolitical factors, the economic factors, and sort of the headlines that you see out there are impacting markets, but we're focused on individual companies, and we're talking about big markets. There's a lot of structural change that's happening on the ground, lots of potential for consolidation. So there's a lot of companies that continue to do well, and as a result of that, are delivering on earnings. And I should say, increasingly, more of those earnings are coming back to us as investors as well. So we definitely like to be paid by the markets, but we're increasingly getting paid by the companies themselves. So, we've got a bunch of companies in the portfolio. If you think about what they're doing in terms of dividends, in terms of buybacks, they're getting into sort of double-digit type returns. So that's I think another encouraging sign that was potentially understated in the market as well. Obviously, you see markets like Japan, where that is, the companies have been rewarded, but I think it's sort of something that's understated, in China. And, it really matters if you look at sort of how that's flowing into the dividends that we're paying in the trust itself. We've consistently grown, that return to investors as well. I do think the biggest returns will come from capital, but income is something that we've consistently grown over time as well.
Dale, thank you so much for talking to us.
Thanks, Danny. It's been great to chat.
Thanks to Dale Nicholls. Some really interesting insights there from one of the most well-known portfolio managers investing in the area. Now, with taxes on the rise, potentially, investors are always on the lookout for ways to protect their investments from the clutches of HMRC. And venture capital trusts, or VCTs, are one way to do that. Leif, let's kick off with the basics. What exactly is a VCT?
Okay, well, VCTs are very similar to investment trusts. To all intents and purposes, they are a type of investment trust. They're closed-ended investment companies. They're traded on stock exchange. They're run by a professional fund manager, and that professional fund manager invests in a portfolio of underlying companies. But there are two very important features of VCTs which mark them out from standard investment trusts. The first is that investors are eligible for tax relief if they buy newly issued shares in VCTs. And there are also strict limits on the size of the companies VCTs can invest in. And those are small companies, usually at an early stage of development, and often, but not exclusively, often not quoted on a stock exchange themselves. And given the profile of that kind of portfolio, clearly there are bigger risks involved. Some of those companies in VCT portfolios, they won't make it to maturity. But the hope is that the gains from those that do will offset the losses incurred by companies in the portfolio that fall by the wayside. And there have been some very high-profile success stories that have been funded by VCTs that I'm sure people will have heard of. One example is Virgin Wines. Also Zoopla, the online property company, and the healthy snack producer Graze. So that maybe gives you a kind of flavor of the sort of companies that have been coming through some of these VCTs. Now, some VCTs are generalist in nature, and what I mean by that is that they invest across a range of sectors, but there are some which specifically focus in on one sector alone, and technology and healthcare are two sectors that VCTs seem to kind of zone in on. So obviously, as I said, because of the small size of the companies that VCTs generally invest in, they're already very risky propositions. But I think it's fair to say that those that focus in on just one sector, actually that elevates the risk even more.
That's interesting. Yeah, and you mentioned tax relief. I'm sure that will have piqued the interest of some of our listeners. Can you explain exactly how the relief works?
Yeah, absolutely. And yeah, you're absolutely right. I mean, that is one of the major reasons that people invest in VCTs. And, the main bit of relief that you get is actually 30% income tax relief on your investment. That's subject to a maximum investment of £200,000 in each tax year. So if you put in £200,000, in that case, you'd be eligible for £60,000 in tax relief. And you'd normally claim that through your tax return. So it sounds like a pretty sweet deal. Now, importantly, you do have to have paid that amount of income tax to be able to claim the tax relief. So you can't claim back tax that you haven't paid. So for instance, if you've only paid, say, £30,000 in income tax in a tax year, that's the maximum tax relief you can claim back through a VCT, no matter how much you invest. So really, you'd probably just invest £100,000, get £30,000 in income tax relief. You also, it's important to recognise, you have to buy new shares to qualify for the tax relief that are offered by the VCT managers when they're raising money each year. And I say that because VCTs do also trade on the stock exchange, on the secondary market. So, investors exchanging the secondary shares. If you buy them there, you don't qualify for the tax relief. And there are also, a few strings attached. You do have to hold the VCT shares for a minimum of 5 years to stop the tax relief being clawed back. So that's the income tax relief. And also, once you're invested in the VCT, capital gains tax and dividends. Capital gains and dividends are free from tax. So that's another perk of the VCT wrapper. And there's no IHT relief, inheritance tax relief, actually, even though some of the underlying companies might qualify in virtue of being AIM listed or unquoted. And some of our listeners may have heard of this kind of exemption called business property relief, where small unquoted companies or many AIM listed companies, if you die after holding them for 2 years, you can pass those on to beneficiaries inheritance tax free. Now, VCTs, even though they might invest in those companies, if you invest in a VCT, you don't get the tax relief. We're actually recording this before the budget, and there has been some speculation that the Chancellor is going to do away with that business property tax relief. And if you listen to this after the budget, then congratulations, you know more about that than we do. But either way, that relief doesn't apply to VCTs or indeed any other collective funds which might invest in unquoted or AIM-listed companies.
So the tax relief, even with the caveats you kind of put there, sounds pretty appealing. Why doesn't everybody invest in VCTs in that case?
Yeah, I mean, it's a good question, really, because like you say, that is a very attractive set of tax reliefs. But of course, VCTs are very risky because of the nature of the companies that they're investing in. So you do have to be a very adventurous investor to take on that risk. You also probably have to be pretty wealthy to make the most of the tax relief, bearing in mind that many people can get tax relief on their pension contributions. They can also hold investments within an ISA for tax-free growth and income. So there are probably more everyday tax shelters there, pensions and ISAs, which are first in line for most people, and within which you can kind of manage the risk as you see fit. I think typically if you've maxed out on your pension and ISA contributions and still have a tax bill to offset, that's when a VCT might come into the picture. So again, probably suited to wealthier individuals who are perhaps more experienced in these things as well. I'd also point out that the charges on VCTs tend to be significantly higher than normal investment trusts. So there's often an initial charge, sometimes as high as 5%. Though it's often possible to get that discounted if you buy through a broker. But annual management fee is pretty high as well, often in the region of 2%. And then on top of that, you've often got admin costs, sometimes a performance fee as well. So investors probably need to take all that into account as well before investing.
And in practical terms, how exactly do investors buy and sell VCTs?
Yeah, well, as I said, you can buy them on the London Stock Exchange on the secondary market, but you don't get the tax relief that way. So you can buy them direct from the VCT company, the newly issued shares, the ones that come with the tax relief, or you might sniff out a VCT broker who can probably give you a discount on some of those hefty charges. You could potentially buy them through a financial advisor, but clearly if you're going down that route, there'd be a cost to receiving the advice as well, which would be a separate service. And in terms of selling them, you can do that on the market because they are traded on the market like an investment trust, but they're not very liquid. And that's not very surprising when you think of it, as very few investors are going to be there to pick up your shares on the secondary market when they're not getting any tax relief attached to it. So what that means is that if you are selling on that market, you're probably going to have to sell out at a fairly chunky discount to the net asset value. But one other alternative that some trusts offer is they operate what's called a share buyback scheme, where they offer to buy back shares from investors who wish to leave. Normally, that's at a fixed discount to net asset value, which is probably better than what you can get on the open market.
Right, thanks for that explainer, Laith. Now, turning to the world of bonds, a lot of people rely on their investments to pay the bills, and there is a group of investment trusts who hope to attract just such individuals with generous dividend yields. Among them is CQS New City High Yield Fund, which invests in a range of assets, predominantly fixed interest securities. Our very own Dan Coatsworth caught up with the fund manager, Ian Franco Francis, about the trust to find out what's in the portfolio and what a falling interest rate environment means for a bond investor.
You offer an 8.7% yield. Does that involve taking above average risks to get that level? Because that's fairly generous compared to, so say, most sort of mainstream investments.
Yeah, if you take average yield as investment grade, then the answer is definitely yes, it would be perceived as greater risk. The answer is you have to do a lot of work in researching the companies, where they operate, what the politics are behind where they're operating. But a lot of the the major part of the portfolio, we have a lot of financials in there, which are mostly United Kingdom financials in companies that are well managed, well run, and obviously post the GFC very well funded. So our biggest holding is Co-op Bank, and that's got a coupon of 11.5. Admittedly, it's not paying 11.5 because it's performed very, very well and it's trading up at 120. But that's the sort of thing. You do the work, and hopefully you get a capital gain out of it as well, providing you've got it right.
Well, what have you got in the portfolio at the moment? Perhaps can you sort of talk through the thought process of why it was picked?
One of the oldest holdings and longest held businesses I've got is Galaxy Finco, which is domestic in general, which is an insurance of white goods and doing the work for the manufacturers. That has been for about at least 5 years. I had it before. You look at the business, you see that it's got good cash flow. The balance sheet is strong, but at the end of the day, the management has to pass the smell test.
Well, I mean, obviously, you're a fixed income investor. I think perhaps a lot of our listeners will be more familiar with investing in stocks and shares. How do sort of these two different investors groups go about doing stuff? I mean, are you looking for different things when you're perhaps looking for a bond to invest in compared to someone who's looking for an individual company share? Or are really you doing the same thing? It's all about a decent company that can either pay a bond coupon or can pay a dividend and do so year in, year out?
Yeah. Well, a quick bit of background on me. I was a convertible specialist for many years when I was stockbroking and investment banking. So you're looking effectively from pure equity to pure debt. And to be fair, the only difference I find when you're analysing companies really is that credit analysts tend to be in the half-empty glass camp, and equity analysts can be a little bit too bullish. But what you try and do is balance the two. At the end of the day, a good company will come through. It will. It may not have the cash to repay the bond, but it is in a good enough position to be able to refinance the bond for the next 5-year period, or pay some of it down and refinance the rest. It's there's a lot of sort of variables, but at the end of the day, if you've got companies that, for example, are paying a high dividend yield, they can be exceedingly well managed, and they might not be increasing their dividend every year, but their sort of dividend is safe longer term because of the way the company's managed. And it's sort of, it goes back to, equity analysis is very useful to me because I like to see, the positive side as well as, the sort of slightly more negative that will come out of my credit analysts.
I mean, we're in a sort of a situation now where interest rates have been high and they're starting to come down. Is that a negative situation for you as a sort of fixed income investor? If we see generally the cost of borrowing is going to fall, bond yields will fall as well.
Well, if bond yields fall, guess what? The prices go up. So you get it's a gentle fall in bond prices gentle fall in bond yields is good for most fixed income investors. It's certainly good for higher yield, because the companies will not just have their sort of listed debt out there. They will have some bank borrowings, and they will come down much quicker. So I mean, by and large, if you see interest rates fall again in November and again in December, and we're down to 4.5, then I think you could see by and large prices moving up gently. I mean, against that, of course, we've got US elections, so it is only one part of the mix when you look at the sort of the movement in rates, but by and large, it is positive.
Well, what about if we get a situation where rates do come down further? If the cost of borrowing is a lot cheaper, might companies just simply go to the bank and borrow cash that way rather than issuing debt through bonds? And if so, does that mean that your sort of pool of opportunities gets smaller?
A lot of it depends on the smaller companies. Actually, it is a lot easier, and there's less sort of clauses in the paperwork with a bond than there is in bank debt. Bank debt can be quite it can hold you back. You've got to have. They like you to see a certain amount of cash. They like to see a certain amount of multiple interest cover. Whereas you can issue debt with slightly looser clauses than the bank would say, and probably at cheaper rates too.
I mean, just looking at the fact sheet, you've made a bigger share price return over the last 12 months, just over 25%, than actually that you've made over the last 3 years, just under 20%. So what's been so special about this last year? And I guess what might someone expect from the trust in a sort of a normal year?
I mean, since I've been running the trust, it has returned around 8% per annum, and that is from 2007. Obviously within those periods, you get a bit of volatility. I mean, in the last year, with rates turning and coming down, you have seen, a lot of companies, bonds, for example. I'll use Co-op Bank as an example. When they refinanced their bonds back, it was the time of just around sort of the Liz Trust time, if I remember correctly. They had to pay up for the coupon. Well, because it's a 2034 date, it's quite a long one, and therefore I'm going to be getting a good rate until then. But it has gone up sort of 20% in the last 18 months, which gives you a nice capital. I mean, yes, we do also use an equity element. We hold stocks such as M&G, Phoenix, which are big behemoth companies, which are producing a yield of around 9.5%, and they're exceedingly well managed. So that also helps us.
Now, from high yield to high octane, Scottish Mortgage is the biggest investment trust in the UK. And for the first time in a long time, the trust has underperformed on a 5-year time frame. Tom here and Steve Fraser, news editor of Shares Magazine, discuss what's next for the falling star of the investment trust world.
So we're talking about Scottish Mortgage, which is an investment trust that looks to find growth companies, exceptional growth companies, both companies that are listed on the stock market, but also in some cases companies that aren't listed on the stock market yet. And it's historically been a sensational performer. So in the wake of the financial crisis, probably all the way through to the end of 2021, when its remit of investing in sort of said growth companies was all the rage, it was a phenomenal performer. But for the first time probably anybody can remember, it suffered the ignominy of having underperformed its benchmark on a 5-year view. And crucially, that's a time frame which Bailey Gifford, which is the trust manager, believes is most useful when assessing its performance. So with that in mind, Steve, let's talk a little bit about how it's performed more recently than that. So, how it's been doing in 2024 itself.
Yeah, hi Tom, and hi listeners out there in podcast land. It's done not so bad this year. The share price is up about 25%. That's over 1 year versus the benchmark, which is about 20%. It's been recovering, and the point made by the trust to me recently. I spoke with one of their directors, Stuart Heggie, and he was arguing about how the last 3 years or so have been really weighed down on markets for growth stocks in particular by higher interest rates, which basically discount the future growth of your growth shares. So that's been a major factor in its underperformance. And to put that into some kind of context, over 3 years, as you mentioned, 5 years is Bailey Gifford's preferred benchmark, but 3 years is a pretty fair time to assess performance, and it's been pretty awful. There's no real way of beating around that bush. It's down about 40% in that 3-year period, and the benchmark, which is the FTSE All World Index, is up about best part of 30%. So there's been this massive dichotomy there in splitting in terms of performance in Scottish Mortgage's share price, its NAV performance, and the benchmark performance. So it's been a struggle, certainly.
And what's that done? I mean, obviously, with investment trusts, they can trade at discount to the value of their underlying holdings. So I wonder what that's done to the sort of discount that Scottish Mortgage trades at.
Yeah, I mean, it's narrowed significantly over the last sort of 12 months. I mean, it was, I think about a year, 15 months ago, it was up to around 20%, which is close to its all-time deepest discount. That's narrowed to something nearer 11, 12% now. But I noticed that back in about June, May time, that discount had narrowed to about 7 to 8%. So it started to widen again, which is a little bit of a concern. But I'm guessing that that's partly down to the fact that, again, interest rates haven't come down perhaps quite as quickly as markets had predicted or hoped that they might do. So the discount is certainly a big factor. Bear in mind, I mean, the trust has traded at a premium to net assets at times, but that shouldn't be expected. I mean, its average is about a 6% discount. So what you can realistically say, Tom, is that there is some way to go to narrow that discount down. And when you factor in a slightly healthier appetite for growth stocks as interest rates start to come down, that could have that kind of geared effect for the share price. However, never say never, and we can't predict the future, sadly.
Of course, yeah. I mean, the other kind of thing that fed into, particularly, I suppose, when the discount was at its peak, was potentially the fact that it had, a reasonably large component of unquoted companies. So companies that, aren't listed on the stock market, and therefore their valuation is a bit harder for investors to gauge. Is that a fair observation as well?
Absolutely. I mean, it's always going to be a big talking point amongst its retail investor base. And this is largely because, on the one hand, and this is the viewpoint of Scottish Mortgage and Bailey Gifford, is that it's one of the few trusts that really offer investors an opportunity to buy into the growth of some of the most exciting companies in the world. So we're talking about Elon Musk's SpaceX, for example. So you've seen TV news footage of it sending its relandable rockets into space. It went to pick up those spare astronauts who got stranded there, and so on, or it will be doing that. But it's much more than that. SpaceX has also got this Starlink network of satellites, which should be very, very important and could monetize very, very handsomely down the line. So on the one hand, you've got that opportunity, but at the same time, you've got this kind of opaqueness in terms of, well, how much is that company worth? And Scottish Mortgage are absolutely adamant. I mean, they have independent valuers come in to assess the market value of their stakes in private companies, and they do it on a very frequent basis. So there shouldn't be this massive overhang that you can sometimes get where a company doesn't get assessed in valuation terms until its next funding round, which can sometimes leave big holes in the balance sheet valuation versus the actual real valuation. But that's a little bit theoretical, and clearly in the minds of investors, it leaves quite a lot of grey area, and that's going to weigh on sentiment over a period of time. Other sort of private companies it's invested in is Stripe, for example, which is one of the biggest payment networks in the world, and it's owned by these two Irish brothers, and they've shown no interest as it stands in IPO-ing the business. And that's been another factor. It used to get a regular supply of these private companies reaching scale and then coming to public markets. And then you can see the valuation on the day-to-day basis. There's much more reluctance nowadays for founders to float on the stock market. Presumably they can find cash backers from the private equity world, and they don't really need funds to grow because they're very cash generative businesses. So as much as it's a bit of a frustration that these businesses are not in public markets, Scottish Mortgage, as they argue, allows retail investors to still own stakes in the growth of these businesses. So there's that grey area, conflict versus opportunity. And investors really have to make their own decision about how comfortable they are about having that kind of grey opaqueness in their portfolio.
Of course, yeah. I mean, and it's fair to say that has become a slightly smaller part of the portfolio more recently, and it's not the only area where I guess there's been some rebalancing. So one of its high profile stakes is Nvidia, but that stake has got quite significantly smaller. Is that right?
Oh, massively so, yeah. So to the point, Tom, well, I had to go back to Baillie Gifford after I'd met them recently and double check the numbers because I wasn't sure that they were correct. So the data was showing me that at the 30th of June this year, its stake in Nvidia was worth about 9% of Scottish Mortgage's assets. The more recent data, which is on their website, shows at the 30th of September, that stake had now reduced to 4.1% of assets. Now, that's a massive sell down. So obviously I scurried away and got clarification. And the data is absolutely right. And the argument is from Scottish Mortgages, Nvidia's had a brilliant run. It's up nearly 200% this year alone. They've invested in the business since about 2016. And so it's taken a little while for the real benefit to come through because it's only the last 2 years or so that Nvidia has really flown. But this is what you're buying with Scottish Mortgage. You know, they are seeing opportunities several years sometimes ahead of the rest of the market. And that is really what a retail investor should be investing for. It's that opportunity to spy opportunities, spy investment scope into the future that will come to fruition sometime down the line. And Nvidia is a great example of that happening. And now they're saying, look, we've got other great opportunities that are either unlisted or private companies or listed companies. And we think some of that profit is better deployed in these new businesses. And one example they've been talking up recently is this Latin American banking company called New Holdings. It is listed. It's listed in America, but it's known as New Bank, so NUBANK. And it's looking to provide basic funding and banking facilities to millions of people in Latin America who are either don't have access to easy financing or just unbanked totally. Now, if you think about it from a point of view of a small trader running a coffee shop, say in I don't know, Mexico City, you know, if they want to go from one coffee cart to 3 coffee carts and expand, they need someone to give them capital. And there are loads of these retailers who just don't have access to capital. So Nubank want to provide these kind of small entrepreneurial people with the financing, the access to funding, all through an online platform, and that allows them, therefore, to get some capital, reinvest it in their businesses, and expand and grow to the benefit of both the lender and obviously the vendor. So that's one of the exciting opportunities they've been talking about recently.
What else, I mean, apart from some of these, new opportunities coming to fruition, what else could re-energise sort of Scottish Mortgage's share price, perhaps, into 2025? Are there kind of some obvious catalysts? I mean, I'm not saying you have to say if this is going to happen or not, but if there are going to be some drivers for them, what could they be potentially?
Well, yeah, I mean, as I said earlier, Tom, I've left my crystal ball in the garage. I mean, the interest rates coming down definitely can be a major benefit to growth companies and narrow that discount that investors apply to growth companies when they can get a relatively risk-free return from treasuries. The other factor is that narrowing of the discount that we previously discussed, which still has potentially a long way to run back to the average of around 6 to 7%. But there's another factor that I think is really interesting as well, and Stuart Heggie was talking about this. Is one of his particular jobs is to widen the market of potential investors of Scottish Mortgage stock. So it has a global investor base, but it's really well known in the UK, obviously. And the US is clearly untapped or undertapped from their point of view. So what Stuart's going to be doing, he's going to be clocking up lots of air miles, flying out to the US, flying around the US and talking to wealth managers, fund managers to say, look, this is what our investment philosophy is about. This is the kind of returns we've delivered in the past. This is where we stand now. This is why we believe going forward, we can repeat these kind of past returns into the future. Now, if you think about how much bigger the US investment market is compared to the UK, that's an enormous opportunity. Now, I won't be expecting, to get millions and millions of US investors, over the next few months. This is going to be a long-term curve. It may take several years to really start ramping up. But as the brand of Scottish Mortgage becomes better known in the US, it will start to appear on more fund manager registers and in portfolios of retail investors out there. And that can only be a good thing because, as we know, with investment trusts, is the more people who want to buy the shares, the share price will go up. It's demand driven, like any share price is. So that's a third factor that should really help seed a positive sentiment, positive mood going forward over the next 3, 5, 10 years from now.
Okay, thanks to Tom and Steve for that. That's all we've got time for in this episode. We'll be back as normal later this week with the regular Money and Markets podcast. Until then, thank you for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.